that we have mentioned that we have invested 100 crores. The corresponding previous year was 22 crores of other expenses in the new verticals. This year it is 69 crores. So the increase is 47. So 111 plus 8, 119 plus 47. That is the kind of not apple to apple. New verticals, Ted Baker and Gary Weber. And if I exclude this, then the like to like last year number FY23 was 529 and this year it is 550. So the increase is actually 4% in the other expenses. The number is looking higher because we have added 2 new verticals, Ted Baker and Gary Weber, and added numerous new verticals in terms of growth strategy. That's the like to like comparison piece.
Okay, understood. And final question, so in Q3, the employee cost was around 270 odd crores, and that included, I think, a one-time bonus or incentive of roughly 25-30 crores. But we haven't seen sequential decline in employee costs. So is there anything? What's the reason for this?
Yeah, in fact, some of these questions that you asked us have enabled us, kind of look deeper. And as I answered on other expenses, in the same manner, the employee cost is 984 crores in FY24 and was 761 last year. That's an increase of 223. Now, in the increase of 223, there is Ted Baker 65, there is Gary Weber 22, and there are new verticals. The employee cost was 32 crores in FY23 and it is 95 crores in FY24. That's approximately 64 crore increase. Then there is North America is about 7 to 8 crores. So if I exclude this Ted Baker 65, Gary Weber 22, new vertical 64, North America about 7 to 8, the increase is 66 crores from 730 to 795, which is a 9% increase on an overall basis, which we believe is the normal increase given small increase in headcount and an overall inflation or so. So that's the answer to the question in terms of, how we are explaining the employee cost increase.
Understood. Thank you so much.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, hi. Just to the continuation of the preceding question. So then this Ted Baker account, what margins is it making at the reported level for us?
So Ted Baker, I'll try and take that question. For the full year ended March 24, we did about 507 crore of top line. We had a gross margin of about 41%, and in terms of PBT margin, it is approximately it's about 28 crores of PBT. That works out to little less than 6% of PBT margin. So that's 41% gross margin, 6% PBT margin.
Can you give the EBITDA margin?
EBITDA margin of the business is about close to 6.5%.
And how much have you invested? Because when I'm looking at your cash flow statement, I can see trade receivable 570 crore invested into, 160 crore invested into property, plant and equipment, and 158 crore invested into acquisition of non-controlling interest in subsidiary and all these places. So that's totaling about 160 plus 150, 20 plus 570, about 800 crores. So how much did Ted Baker attract investment from your side?
It is circa 150 crore. That is the amount of check we wrote to begin with, and subsequently we did recover part of the investment through working capital squeeze. So if I'm giving an approximate number, I think the 150 is down to close to 100 to 110 crores. The 40 crore got squeezed. But today the answer is 150 is down to little less than 110, and on that our EBIT is 33 crores. You asked me about EBITDA, and the EBIT number is 33, so it is approximately a 30% ROC on the last year performance. And I'm counting 33 is from June end onwards, June beginning, May end. So therefore I'm not analyzing it. For the period that we were holding, it is 33 crores of EBIT on the business, and the net investment as on date is approximately 110. That's the metrics of the investment decision.
And from your cash flow, if you could tell why has the trade receivables increased so much by the year end at 570? And what are these other two investing that you have done? 162 crore in property, plant and equipment, because you haven't done this kind of a capex earlier, and the consideration paid for acquisition of non-controlling interest of 158. So what resides in these 900 crore of cash flow items?
Rahul, you want to take that, then I will chime in.
So, Pratish, your first question was, if you could just repeat the first part of the question.
Receivables.
Pratish, if you could just repeat the first part of your question.
So I'm looking at the cash flow. There is change in trade receivable 570 crores. So that's a fairly large number. And, so basically the question is from cash flow generation usage. Your cash flow is low in generation because there's a 570 crore receivables for no growth in sales. And then on the top of it, you have invested about 320 crores in the property, plant, purchase, equipment and acquisition and non-controlling interest. So if you could explain what all is this?
Sure. So, as far as receivables is concerned, a large part of the receivables increase is on account of the Tech Baker business, as well as a few of our large customers increasing the number of days as far as payment days are concerned. So both these led to an increase in the overall receivables number as far as this year is concerned. As far as your second part of the question, which is around investment in property, we last year had liquidated a property in the UK. Our three large businesses, which is Poetic Gem Design Art and Ted Baker, all work out of rented premises, and particularly Poetic Gem, which itself aspires to be $1 billion business in the next 4 to 5 years. So there was a need for us to have a better office. We were operating out of more like a warehouse come industrial area in Watford in London, and we invested about $10 million in acquiring a property which we feel will be appropriate for the size and shape of our businesses in UK and also the customers that we handle in UK. So we thought that this investment was required during the year. So that's where we invested about $10 million in this property in Watford in London.
But that still explains out of 320 crore, $10 million, which means about 80-90 crore. So you have 162 crore invested in purchase of property, plant, equipment, capital work in progress, and investment in property. That is 162.
So Pratish, $10 million, as I said, about 90 crores is this property. Including tax and all that you have to pay, it will overall come to about 11.5. So let's say 100 crores in this property. We do about, every year across our verticals, about anywhere between $6 to $8 million of capex. This year, it was slightly higher because one of our businesses, third largest business, which is Simple Approach, set up a sampling unit in Bangladesh, which led to a slightly higher capex than what is routine. So about $9 to $10 went into capex, and our PDS venture investments in any year are around $5 to $6 million, which is basically calls coming from the existing investments that we have done, plus any new opportunities. So we usually restrict it to around that level. So all of these put together, and including a small capex in our Sri Lanka operation, all of these put together add up to another 180-200 crores.
So this 158 crores is those PDS venture investment, which is usually about $5-6 million.
No, Rahul, just allow me to...
PDS venture is not 158 crores.
Sorry, allow me to chime in here. I think in the order of the question that you asked, firstly, the receivable, as Rahul explained, went up.
I understood that. I understood the purchase of property,
Yeah,
plant and equipment.
just allow me to, address all these points. While the receivables went up, the corresponding payables also went up. If Ted Baker we exclude, the net working capital is 1 days. Typically, we manage 0 days, 1 day's net working capital. So in our business excluding Ted Baker, we are bang on there. Any increase in receivables is also corresponding in, managed through payables, so no increase there. Rahul answered that we had a 60 crore capex in year FY23, and we have a capex of about 167 crore. That's almost close to about 110 crore increase. And he answered that about 10 million, which is about 85 to 86 crore, including some taxes, went into the UK property. But the remaining amount that is there is the capex. That 10-15 crore remaining is the capex in the sampling room of Simple Approach in Dhaka. Is the capex in Sri Lanka. So that's the explanation. So capex is in line with what happened last year, except the investment in the UK property. And in fact, we have invited our investor community to be part of the investor day on 11 June, wherein we have invited all the business heads from UK to also be present, and they are very excited themselves to scale up the business to $1 billion from about 400 million right now. In terms of the venture tech investment, we invested close to 70 crore in venture tech investment last year in FY23. And as you see for cash flow, the investment is about 29 crore in venture tech investment. And in respect to the Ted Baker, we mentioned about 150 crore. That's part of the acquisition of Ted Baker 155. I think so the venture tech investments are down. The capex is in line, plus the addition of the UK property. And the 150, as you asked earlier, was in the Ted Baker business.
Okay. So that 157 that we see is all Ted Baker investment.
That 52 crore, yeah, the acquisition of TDG, Nobles and others, that 155 crore number that you see, it includes Ted Baker. We also mentioned in one of our releases that in a factory in Sri Lanka, which is making an EBITDA of about 15 crore, we invested about 1 million, about 8 crore to get a 26% stake in that business. So that's also captured here. That 8.5 crore to buy a 26% stake in a factory in Sri Lanka with EBITDA of 15 crore is also captured here.
And sir, from your opening remarks about this interpretation of adjusted and the reported margin, how should we interpret now this for FY25? And when you say that you have started your order book at $585 million, which is plus 30% YOY, how should we interpret it for your future for FY25? Now this 585 will also have, I don't know whether it's a GMV value, how it is. How should we interpret this number with your revenue performance, purely your revenue performance, and the margin adjusted reported for FY25?
See, on the margin, as we have mentioned by giving the 3 sample actual cases of CASA Collective and PDS Far East and CSS, it takes about 2 to 3 years from the investment phase to these businesses becoming to their full potential. And given that FY24 was a year of large investment, relatively large, so we will continue to report normalized EBITDA to enable our stakeholders see this. But in about FY26, I think we should start seeing a significant benefit coming in from these investments. It can be sooner, but that's therefore the normalization impact we have to capture in FY25 as well. That is answering your first point. In terms of the order book, when we're talking about almost a 30% growth as compared to the same period last year, this is the order book which is equivalent to the way we book revenue. This is not that we are saying that this is a $585 million Sarkar number is a GMV number. This is what actually is the number that gets booked into revenue. We have mentioned a 10% year-over-year kind of outlook that we are seeing ourselves. Currently, we are very positive with the order book in hand, 30% up. But I think we are a bit cautious given the overall environment. But at present in hand, the order book is much better than the 10% that we are aspiring to grow the year with.
When you said normalized margin, your normalized...
Mr. Chheda, maybe...
Sir, I just want to finish this question. When you say normalized margin, you mean normalized margin of FY23, which was 4.5%?
Yeah, we have done apple to apple. So when we have given normalized EBITDA of 4.7% was in FY23, and the corresponding number is 5% in FY24. And the only main exclusion to arrive at the normalization is the investment in new verticals. Nothing else.
So if I have to understand your comment properly, you are saying that FY25 we go to the normalized margin number of FY24 as the reported number, and then whatever increments we see thereafter.
Yeah, I think firstly we would request, we are very happy to get all your questions, and we would really request if we can have a one-to-one meeting to get deeper so that we can take more questions. But taking this as your last question, yes, our endeavor is that whatever is the normalized EBITDA for FY24, we should target to achieve that as the EBITDA from normal operations post the investments.
Oh, thank you very much, sir. Thank you very much.
Thank you. The next question is from the line of Chirag Fialuke from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you so much for the opportunity and congratulations on the traction on the top line. Just two clarifications. So Tech Baker this quarter was around 162 crores. Is that correct?
Yes.
And could you just share the same number for sourcing as a service for this quarter?
Yeah, we will just that, we'll answer that in 1 minute time. If you have any more questions, sourcing as a service for the full year that we have booked as a revenue, and Reena will just help pull out the quarter number, is 215 crore out of the 10,373 crore revenue that we reported. The sourcing as a service and agency is about 215 crore, and it was 66 crore in the same period last year. Q4 number, I will just come back to you as we take more Q&A.
Perfect. So 215 crores is the total for the full year for sourcing as a service, just to confirm, right?
That's right. Commission income from sourcing as a service and the agency income that we get otherwise was 215 crore for the full year against 66 crore in the previous year.
Perfect. Understood. Thank you. Just one clarification question. I think the previous participants also sort of were trying to get around to this. The page number 31, which is the FY25 outlook on the presentation, you talk about 10% top line growth, which you're saying is sort of mildly, being conservative a little bit based on the order book, but given the environment. What is puzzling is more the profit growth. A 15% PAT growth would mean a far lower margin still in FY25. Is it a plan to continue investing through the P&L for new ventures, or am I missing something? Could you just talk a little bit about sort of profitability for FY25 a little bit, if that's possible? Thank you.
So I think you have to permit us to be a bit conservative. We want to make sure that we are in a position to try and beat these estimates that we have for the year. And our endeavor is to improve the margins, going forward as well. But as I said earlier, the verticals that 100 crore that we have invested would continue to be in the gestation. But on an overall basis, to answer specifically your point, we achieved a PAT of about 2%. And I think we will endeavor to improve it for the year on the whole. If that means more than 15% growth, then that is what we will strive towards. We're not anticipating the PAT margin to decline going forward.
So if I may add here that, the market, as we mentioned at the start of the call, last year, the market conditions were very challenging, very tough in the markets we operate in. And while we have seen, good amount of recovery in Q4, and we expect the trend to continue, but we rather be conservative, wait and watch for a couple of more quarters for both top line recovery and bottom line margin expansion to start happening. So it's still not, a situation where we can, get aggressive and say that we will deliver an X amount of growth in bottom line. We will rather be conservative and wait and watch for the market to bounce back.
Understood. That's clear. Just so that, my question is clear. So if I look at the page 21st of the presentation, is in general, you guys think of 30 crores as an investment in new verticals. In FY25, do you anticipate investing a lot more than that, or is it going to be around the normalized range? I think that's the only thing that's kind of under our control. The rest of the environment, whatever happens, happens. But what do you anticipate as investment into new verticals for FY25 broadly?
I think 2 points to clarify. Firstly, on your previous observation or question, a 10% growth in top line, a 15% targeted growth in profit, when the profitability is improving at a higher percentage, clearly indicates a better PAT margin. If we were at 2%, with these kind of numbers, we should do better. That is point number one. We have invested about 100 crores. I think our focus this year would be that let us retrieve more value from the investment we have made. So therefore, at this stage, we are anticipating to bring this number down. We will continue to keep investing, but if I have to prioritize, let us harness what we have invested into rather than committing more. So therefore, this number should gradually sequentially come down.
Understood. Fair enough. Thank you.
Thank you. The next question is from the line of Lovesh Soin from Phoenix Advisors. Please go ahead.
Yeah, thank you for the opportunity. My first question is that despite the accelerated investments in the US market that we have made over the last few quarters, it seems like the revenue from North America business has declined 15% year-on-year in FY24. So what is the reason for such a degrowth despite these investments, and when would our efforts in US start to produce tangible results?
I will also request Mr. Palak Seth to, allow me to firstly answer the number part, and I'll request Palak to add in on the US strategy. I think hitherto we were catering to North American market, sitting from where we are, whether we are in UK or Hong Kong or in Bangladesh. It is in this year that has just gone by that we actually curated a strategy and let us invest into senior resources with relevant experience. Let us have people on the board, whether it is at the board of directors or whether the senior people employed with us. So that is where we believe that, it was a tough market for US. We all are aware of the inventory issues. We all are aware of the overall high interest rate and low sentiment environment. So, but now that we have invested into these people, we've got, camp on the ground. That is where we are very bullish on, scaling up this number. And I'll request Palak to please add in terms of what is the game plan and strategy, please.
Yeah. So overall, US inventory levels are extremely high last 12 months. They started normalizing, during the Christmas period. So this year we are seeing the bounce back of demand coming from customers. If I speak to most of our customers and, the competitors, they were looking at almost a 30-35% decline on the buying they were doing last year versus, the year before. So now situation has improved, but, PDS in the last 12 months has onboarded some of the largest American retailers as customers. So, Sanjay mentioned about Target US, which has, got a $50 billion apparel business, Walmart US, Kohl's, Lands' End. So, some very big American customers have now chosen PDS as strategic vendor. And, we feel that the investment in the quality of people we are making is going to facilitate huge growth of that business in the next 12 to 24 months. Walmart had a summit in India. They came to India in, I think, February, March this year, and they met almost 65 vendors to talk about strategy and growth. And only one vendor was invited back to Bentonville, which was PDS. So out of 65 evaluation of different companies they did on the apparel side, PDS was the only company that, was invited back to Bentonville, where we went and met them last week. And, they're asking us what is our 5-year vision with them. So our 5-year vision, we forecasted that we want to do $400 million with Walmart in 5 years time from now. So, they're the kind of discussion we're having with these retailers in a time where vendors are being consolidated. And, it takes time, right? Everything takes time. Opening the account is the first step, and actually discussion with senior leadership is second, and then, investing in the right team to make sure that all the discussion happens, gets into business that can be executed is the third. So, we've taken all the 3 steps, and hopefully by H2 this year, we'll see our US business start picking up and orders flowing in. So the real impact will come in next financial year, but this year already green shoots and, all the positive news has started flowing in. And actually we'll see big upswing on the business from the US.
Got it. Thank you. Just follow up that, given that these large customers you mentioned, Walmart, Target, and Coles, already have their on-ground sourcing teams in Asia. So how big can PDS become as a part of their overall sourcing?
Because the sourcing teams are the one who are putting PDS forward. Our interaction with Target US is through their Bangladesh office, because they only work with 4 vendors in Bangladesh. Today, in my view, if you are a factory in middle of Asia, be it in India, be it in Bangladesh, be it in Indonesia, be it in Vietnam, has zero value to a customer. There are 10,000 factories globally. No one is interested, no retailer is interested to talk to another factory, to honor another factory and do business with them. The only thing they're interested is every retailer has got pressure of margin, design, FOB IDP, sustainability, circularity. So there are a lot of things the retailers are facing in the home market where they need to align with strategic deep suppliers to be able to fulfill those objectives. That's why Target US said that they evaluate 180 vendors since COVID. PDS is only one that got added. And PDS doesn't even own large factories, but because of the element of design and the entire investment we have done in our whole sustainability and circularity side, this is number one objective from Target, how to make the supply chain more sustainable. They say PDS is a company based on all the investments we have made to provide them solutions on that journey. And that's why added as a vendor. If you look at Walmart US, there are 3 strategies from the CEO's office last 2 years, which they are now in their 5-year plan. One is made in India, other is made in USA, third is sustainability of supply chain. So PDS was ticking almost all 3 boxes. Made in India, we did a partnership, like a joint venture with a factory in Mysore, which we have put forward. Made in US, we through our venture arm, we have a company called Unspun, which now is putting plants in the US. Obviously, it's a small investment from PDS, but that company is now partnering with Walmart to set up some manufacturing plants in the US. And third, on sustainability side, they see the solution we are providing is very, very, important for how they are looking at their own supply chain going forward. So the local office of these retailers are the ones talking to PDS and putting us forward as a solution provider to the head office in the US. I hope that answers your question.
Thank you. Yeah, that does. Thank you. Just one last question from my side. With 10% revenue growth in FY25, the ask rate for FY26 and 27 to meet the 2.5 billion revenue target in FY27 that we set a couple of years back is very steep. So how confident that we'll be able to achieve that 2.5 billion target in FY27, or is there a deferment to that, or are we deferring that plan for now?
I think as Sanjay mentioned, we already have a 30% uptake on order book compared to last year, which is very few companies can say this in our industry. Still, the industry is highly challenging. There are a lot of companies, a lot of suppliers going out of business, a lot of retailers consolidating. So in that consolidation, if PDS is seeing a 30% growth in our order book on H1, which is a positive sign. So, but as he said, also to be conservative, we are giving guidance of numbers, which we feel, because we don't know what happens in H2, but overall situation looking quite positive. So hopefully, we will obviously beat our guidance for this year as well.
And that means that we are continuing with that 2.5 billion revenue target for FY27.
I mean, yes, this is the plan, but PDS will not take any unnecessary risk to its business model, to force anything. But yeah, the kind of opportunity we are seeing and the customer engagement we are having, we can easily see, a lot of growth being projected by existing customers and strategic discussions happening with most of them.
Thank you for that answer.
Thank you. Ladies and gentlemen, we would take that as our last question for today. I would now like to hand the conference over to Mr. Sanjay Jain for closing comments.
Thank you so much, ENY team. Thank you so much, our investors, for joining, our stakeholders for joining this call. We would welcome that if anyone wishes to have a one-to-one conversation or group level, we are available. We have also sent you a save the date for June 11th in Geo Center BKC. We are hosting our Investor Day. We are inviting our top 5-6 business heads who are flying in from various locations to get an opportunity of meeting you and vice versa as well. So kindly do join us. Our Investor Deck will be emailing the complete agenda by the end of this week, and we look forward to your participation. Thank you so much. Thank you, everyone.
Thank you, everyone. Thank you.
Thank you. On behalf of PDS Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.